credit. And to start with that, I want to give an update on forbearance. So first and foremost, to anybody who is listening and doesn't know, part of the CARES Act that was tied to relief with regard to COVID-19 established that you could apply for a forbearance or a delay in making your payments associated with your mortgage. And many had heard that, hey, I can go ahead and just stop making my mortgage payments. Of course, early on in the process, we were out saying, hey, exercise caution with that. Nothing is free. And that still remains true. However, we've gotten additional guidance as time has evolved here over the last couple of months that have brought clarity to forbearance. And you still, if you are in a situation where you have the need to exercise forbearance, you absolutely need to contact your servicer to talk to them about that process and understand very clearly what it is that you're going into. When will you have to pay those payments back? How will they work? Because you will have to ultimately pay them back. But as things have progressed, we've learned that the vast majority that those loans, there will be either an additional loan or a modification of your current loan that may push that to the end of your loan term. That's a very, very high likelihood. However, there are different options with different loan types and different servicers. And so you just need to know that there isn't a one size fits all with this. And you absolutely only want to exercise it if you 100% need it, meaning you cannot make your mortgage payment otherwise, right? There's not another alternative. And part of the why behind that, as we've talked about previous, is that if you do enter into forbearance, the former guidelines said, hey, if you entered into forbearance, then you couldn't qualify for a mortgage for a minimum of 12 months after you exited forbearance. There's been some new guidance for primary conventional loans, so Fannie Mae and Freddie Mac. I know that sounds like a foreign language to those that are listening. So those are your primary conventional loan providers. And they've come out and said, hey, if you went into forbearance, but you made your payments on time, right? So you still continue to make your payments, you can exit that forbearance and qualify for a new mortgage, okay? So you could refinance or purchase a new home right away if you made your payments on time. However, if you did go into forbearance and you didn't make your payments, you need to be out of forbearance and make at least 3 consecutive on-time payments before you would qualify for a new mortgage in that conventional realm. Additional thoughts on that, ladies that are on and listening? Did I cover that well? Are there additional things to mention?
You did a good job, Carrie.
All right. Well, you never know what I might leave out. So good news from the forbearance front for those folks that maybe just went into forbearance as a backup plan and then inquired about refinancing. I know we got a bunch of those calls from people who wanted to refinance, and we pulled up credit and found, oh, they're in forbearance. We need to put a pause on that. But now we can take a look at moving forward if those payments were made on time, and again, or if you are going to remove yourself from forbearance and make those payments on time for 3 months. So that's an option for us to take a look at. But let's move into talking about the hot topic of credit. There's all sorts of stuff to say about it. And frankly, a lot of questions that came in ahead of our call today. If you do have questions while we're talking, by all means, go ahead and drop them in the chat. I am watching the chat to see if any questions come in there or comments on Facebook, and we will roll from there. But Rebecca, why don't you start with what's the first question that you
Yeah.
got?
So like Carrie said, we've been collecting questions throughout the week on what is credit, what should I do to have optimum credit scores. So the first question, Carrie, is I'm thinking about consolidating my debt so that I can get a better monthly payment. Is this a good idea?
That's a great question. And you know what? I should preface some of this with right away out of the gate, I'm going to say, I know this is not the favorite answer of listeners, but one size doesn't fit all. And credit is as unique as your fingerprints. Like my credit is not the same as Barb's credit or Chris's credit or Rebecca's or Adam's or anybody else who's listening to the call. The reality of that is that some of the wisdom that I may share with you is going to be generic terms, and your individual circumstance matters. So if you're in the process of trying to get a loan or you're thinking about getting a loan soon, please absolutely reach out to a professional who can make sure that they're giving you specific advice to you. But when you say that, the very first thing that I think about in terms of consolidating debt is eliminating positive credit history, because credit has a variety of factors that make up the whole in your credit score. And a lot of people look at consolidating debt, and they do that by way of things like the 0% interest offer that showed up in their mailbox. And then they do what I call balance transfer bingo. And they go ahead and they take their 3 credit cards that they've had for some extended period of time, and they shove them all onto this new low interest card. Maybe it has the no payments, no interest for 6 months or 12 months or whatever. And that can actually be dangerous for a variety of reasons. But the number one that I mentioned is history. So you've got history of many years on these other cards, right? And then you move them over to something that's brand new. Not necessarily a great thing if you eliminate all of that good history and now it's on something new that has no history. The other thing is a large indicator of credit score is balance to limit ratios. So you could have on those other cards, so your balance to limit is like, in simple terms, you have $1,000 limit on a credit card. Maybe you have $500 charged on that card, right? So you've got 50% of your balance to your limit used. Well, if you're doing balance transfer bingo and you combine all of those onto one card, you could end up in a position where almost 100% of that credit is utilized instead of 50, and the lower utilization of that, the better. So the lower balance to limit percentage, the better off you are. Actually, somewhere between 30 and 40% is the sweet spot for maximum balances. So those are 2 reasons why I might think twice about that if that's what the plan is. But if you've got some space and time between where you are today and where you're going to be buying a home or looking at obtaining some large credit, I may consider that it could be a good idea if you were going to an installment loan that had a end date, right? Where let's say you had all these credit cards and you really needed to look at, hey, let's put these all together. And now I'm going to pay them off every month and they're going to be gone in 3 years or 5 years or something to that effect. It really is on a case by case basis.
All right. So what you're saying is it depends.
I know, I love that answer, right? The listeners love that answer.
Got it. Okay.
But it does.
Good. So the next question is, I have some old collections that showed up on my credit report. I'm working on improving my credit score. How much would paying them off help?
So this is a credit myth sometimes, right? And this goes back to one of my favorite quotes is that prescription before diagnosis is malpractice. And I absolutely believe that you have to look at it and know what you're looking at. And we have some great internal programs that will allow us to be able to do that for you, but you want to be really careful about self-diagnosing and going in and paying something like that off. I actually was on the phone with a client this morning who told me that there was a collection that hit that reduced their credit score by 125 points. One collection, $400 medical bill, tanked their credit score, right? And that's a new collection that's reporting. So it's actually a great example of what can happen with a minor collection, right, that gets added to somebody's credit report that's new. That can also be true for it being old. I've actually been in a situation, I had a client, bless her, who was in the middle of the loan process, and she paid off a $68 collection that was almost a decade old, that was sitting on her credit report, but it hadn't reported in a few years, okay? So it literally was when you look at a credit report, it's gonna show when the last reported date was. And if that date is old and all of a sudden you pay off a collection item, all of a sudden that becomes new again. It's gonna report current. So now you just paid off a collection. And that particular borrower for $68 lost over 100 points on her credit score. So I tend to be in the camp of, again, if you are applying for a loan or you're in the middle of a loan process, time out. Don't do that. Don't make any of those changes without the wisdom or input from a loan professional. Otherwise, again, on the other side of that, if you've got some long range time frame, absolutely, I'd knock them down. I mean, I was looking at a credit report the other day and working through some credit help with a client where it was like they needed to be in a 6-month plan where, hey, let's pay these off one at a time and get rid of them because they were all reporting current and they needed to improve their credit score. And you can see dramatic improvement from paying off current active collections.
Yeah, I'm glad that somebody asked that, because it's the opposite of what the average person would think, that if I pay this off, it's going to go away and everything's good. But that's not necessarily the truth. So
we just don't want to get burned.
Yeah. The next question is, I've heard that there are rules about shopping for a house and a car that are different than applying for other credit. Can you explain that?
Yeah, sure. Again, that's another myth. And I think that there are a lot of home loan lenders out there that kind of like to use the fear tactic associated with people shopping for a home loan. You know, you'll be on the phone with them and they're like, well, I just talked to XYZ person yesterday, so I don't want you to pull my credit today because I don't want 2 hits on my credit report because that'll hurt my credit score. And actually the models are set up for both mortgages and autos to allow for you to shop in a condensed period of time. You just need to make sure that that window's short. So you don't want to be applying for new credit every 2 weeks. I would suggest that if you're going to do that, that you do it within a short window. Do it within a week span of time or a 2-week span of time so that you avoid that. But the algorithms are set up so that with mortgages and auto loans, the first one is the one that hits your credit score, and the second, third don't subsequently do that, which is why we often see auto loans. And Rebecca, you could speak to that, being in auto loan finance for years prior to entering the lovely world of mortgage banking, that, you know, you go out and shop for it. You know, you're shopping at multiple different lenders and it'll show up on the credit report for all of the different lenders, but it was just the first one that hit the credit score.
Mm-hmm. Yeah. And I mean, like she said, that's 100% accurate. I had a lot of clients prior to being in mortgages that would worry about the same thing, but in reality, it's just the one time to give you that opportunity to get what is best for you. So I'm glad that that's a change that they had made to that. So the next question is, if I went into forbearance on my house, but I didn't use it, will that hurt my credit score?
Yeah. So that goes back to what I was talking about at the beginning. The CARES Act has in play no impact to credit score. Now, that doesn't mean that it doesn't show up on your credit report, as I already indicated. It should not be negatively impacting your credit score. If you have made your payments on time and you just entered into forbearance, that should not be impacting your credit score.
Good to know. So the next one is, if I am married and I apply for a loan, can we just use my credit, or do you have to consider my spouse's too?
Yeah, that is a question we get all the time, right? And the answer to that is it depends on what state you're in too. But in the state of Minnesota, so we'll talk about the state of Minnesota for the moment because it's our primary audience. And Chris, if you want to speak to Wisconsin, you sure can. But in the state of Minnesota, we can absolutely do a loan entirely with one or the other spouse, and your credit is not joint with exception of the accounts that you're joint on. So if Adam and Rebecca are married, which I think they're planning to be one day, and they have an account together for an auto loan, and Rebecca, you apply for a loan, that's going to obviously count against you in qualifying. However, if Adam has a credit card bill that sorry, Adam, you didn't pay your credit card bill. I don't have to have you on the loan. Your credit cannot be great and I can exclude you and it's all good. I don't have to count those debts. I don't have to take a look at your credit. It doesn't have to enter into the picture at all. A lot of people think that, oh, I get married and all of a sudden I absorb all of the other person's credit history, all of their accounts. I'm responsible for everything. And in the state of Minnesota, that's not the case. Chris, I see you unmuted. Chime on in.
I was just going to say for Wisconsin, if you're applying for an FHA, USDA, WIDA, or a VA loan, I will have to count the spouse's debt.
Yeah.
On the conventional Fannie Mae, the Freddie Mac, that's where I can exclude the spouse's debt.
So what is WIDA, Chris, for those that don't know what WIDA means?
WIDA is a bond program through the state of Wisconsin where it allows it up to 100% financing.
So that's primarily for first-time home buyers, correct?
Correct. Depending upon the income limits, there's income limits. There is county median income limits, I should say, that as far as if you fall within that category, you can take a look at purchasing a house. You don't necessarily have to be a first-time home buyer, but the key to that is taking a look at household income for that loan program.
So same thing in Minnesota, we have a Minnesota housing program that works for first-time home buyers and for move-up buyers, depending on those different circumstances. Same thing, just allows you to get some help with lower down payment or lesser interest rate, depending on the loan program that you're looking at, some different options that are available for home buyers in both Wisconsin and Minnesota using different programs. So Minnesota, doesn't matter. Wisconsin, maybe, right?
And I'm glad that we had Chris on so that she could tell us, because we are, as the Twin Cities, where most of us are from, we could venture over the river into Wisconsin. It's a good thing to know that, hey, they're a little different. So thank you, Chris, for enlightening us on that. The next question is, what is a good credit score anyway? I mean, what should I be shooting for?
Another great question. So here's a common misnomer, and I feel like it's important for people to understand. So many of us have credit monitoring set up where, whether it be on a credit card or through an independent service, you're getting updated on the regular about where is your credit score. That seems to be there's been a lot of credit education over the last decade, and a lot of people that we talk to say, hey, well, my credit score from XYZ says that my credit score is this. Well, that's a consumer credit score. Okay, so that model is going to be different than what pulls up when you go to do a credit card, is going to be different than what pulls up when you go to get an auto loan, is going to be different than what we pull up from a mortgage perspective. Generally speaking, the mortgage credit pull that we make is going to be a little bit, it's going to be not a little bit, a lot more in depth than those other models, right? Because we're looking at extending typically a whole lot of money, right? So that mortgage credit report is going to be most comprehensive. We're going to actually pull up all 3 credit scores, and then we're going to use the middle of the 3 credit scores from a qualifying perspective. What's good in the mortgage world? I mean, I guess here we'll start with barrier to entry. I mean, in general, you want a minimum of a 620. Anything less than a 620, and we probably have some work to do. There are certainly some options that exist out there for financing, but at minimum 620 is what we're shooting for in today's day. That's not a good credit score. That's not what you want to shoot for in terms of, hey, this is a good credit score. I would say good in the mortgage world is in the range of, 660, 680. That would be good. You get over 680 into the 700s, you're starting to get really good, and you get over 740 and you're excellent from a credit score perspective. So depending on your situation and how far you are from that, people always ask, well, what does that mean? I mean, how does that benefit me? And it benefits you in a variety of ways from a mortgage perspective. Chris just named off like 5 different loan types. Every one of those loan types has different guidelines, and they also have different things that are considerations with regard to credit. And the better your credit is, the more options that are available to you from a loan perspective. So if you think about that, more options is generally speaking good, right? So I get to pick. Secondly, interest rate is going to be better, right? The better your credit score, the better your interest rate. Third, mortgage insurance. Anytime that you have less than 20% down on a loan in general, there's going to be some type of insurance, with the exception of a VA loan if you are a veteran. But mortgage insurance rates will also get better, so you pay less in insurance if you have a higher credit score. Lastly, although it's not lastly, there are all sorts of other reasons, but homeowners insurance as well. Your rates are going to be better on homeowners insurance when your credit score is better. And that's a little bit different score, but it does take into consideration all of the same things we do from a timeliness of payments and history and that type of thing.
So again, I feel like this is another, it depends kind of a thing.
Well, you know what? Not necessarily. I mean, better credit score is always better, right? It's going to get you better rates, better terms, more options, and lower payments. And so if I had to pick a number, I would say a good credit score, I mean, this is arbitrary, it's me, it's my opinion, is around 680. And I don't know, the others on the call can say, yeah, that's a really good credit score. That doesn't mean that if you don't have a 680, you can't get a loan. We can go to 620 and sometimes less than that. But if you're looking for something to shoot for, I'd shoot for 700s and beyond.
Now, you had mentioned the middle score. What do you mean by the middle score?
Yeah, so we're going to pull 3 credit scores from the 3 different major credit bureaus in the US. We're going to get all 3 of them. It's called a tri-merged credit report. So we're going to get 3 different scores. Each one of those bureaus has a tiny bit of a different model, and not all creditors report to them. So for example, you may have an auto loan over here at a local bank, and they only report to 1, right? But then you've got a credit card over here and they report to all 3. So you can see right there how maybe that credit score with the one that reports to only 1 could be different than the one that reports to all 3. And therein we end up with variances in the credit score. So we're going to take, if we've got a 640 and a 660 and a 667, we're going to use that 660 as the credit score that we're ranking all of those other things that I just talked about.
Got it. So it's just you put them in order of highest to lowest. It's the middle one.
Yep.
All right. So how does it work if I get pre-approved, but then decide to wait a little while? Do you have to pull credit twice?
That's a really good question. And the answer is, it depends on how long, right? Generally speaking, if you wait 6 months, we're going to need to pull a new credit report. But I think that the question probably derives from something entirely different, which goes back to those people looking into your credit and hitting your credit score, right? So I'm guessing that that's where this question is coming from, is I don't want my credit pulled too many times. And every 90 days, though those credit inquiries are still going to show up on your report, your credit score is recalculated all the time. So if this mortgage is the only thing that you applied for credit for, and you didn't go run around saying yes at every checkout to a credit card or whatever, you're probably just fine if it's been more than 90 days and we need to pull another credit report. But we do need to make sure, for obvious reasons, like, hey, maybe you did say yes and you went out and you bought a new car, or you charged up your credit card or whatever. We can't let that go on forever. We need to know that you've maintained your credit.
Yeah, well, I can attest that every time I go to Express, they say, you're a pre-approved for our Express card. You could save 20% today. And I'm like, no, thank you.
I always say, dare to say no at the checkout line. Just say no.
It's tough sometimes when I make that big purchase, but
I know.
yes.
Way more costly on the other side. Way more costly on the other side.
So how do my utilities impact my credit?
In short, right now, they don't, unless you don't pay them. If you don't pay them and they go into the aforementioned collections, then that could negatively impact you. But right now, most utility companies do not report to credit. And if they do, which there are a small number that do, then we're not counting that against you from a qualifying perspective. In general, generally speaking, they do not report. So they're not impacting you.
Good to know. The next question is, I've been told to not pay off my credit cards, but to keep a small balance on them. Is that right?
I love all of these it depends questions, right?
You know, I did have one.
I know, right? In general, if you have a limited amount of credit or you have a small utilization of credit, and that's where this advice could be coming from. You know, if you're new to the world of credit, you've only had credit for a few years and you have a very limited number of accounts, if you actually don't have activity, then your credit scores can go away, which we see all the time. You know, we'll pull up a credit report, it'll be like, oh, no scores. Well, and having scores is something that is important for the other reasons that we talked about. In terms of whether or not you should leave a balance, I mean, my suggestion is, you'll find me saying, hey, you know what, just go charge a tank of gas, wait for it to report, pay it off in 2 installments, be done. I wouldn't suggest leaving a large balance, but if you're working on building credit, it's important to keep a small balance, pay it off, charge again, just so that there's activity, so that credit continues to build. If you're in a situation where you have multiple lines of credit, you know, you have a mortgage, you have an auto, you have a couple student loans, whatever, then I'd say no to that. So it's situational once again.
Do you have a recommendation for someone who maybe needs to use their credit cards more frequently on what that balance should be?
Sure. So that goes back to what I said earlier around, now, if you're applying for a loan. So many of us, you know, use a credit card for business expenses on a monthly basis, submit an expense report or what have you in order to wipe that balance out on a monthly, and every month we're using it, paying it off, using it, paying it off. That situation, if you're applying for a home loan, you just need to be cautious about the fact that balance to limit, again, that sweet spot being somewhere between 30 and 40% of your limit, that you want to watch out for that, because you're going to maximize your credit score, right? If you're in that 30 to 40% range. So I guess if you were looking for a number, that's what I would say. I would lean to 30.
Perfect. We do have a question in the chat though. What about these companies that advertise increasing your credit score using utilities and cell phone accounts?
Sure. So if you don't have credit, for example, we can build a credit report based on positive history. We can add those items to a credit report in order to show that history. And oftentimes we have to do that in the world of mortgage lending, but they're not going to. So it actually costs money for people to report to the credit bureaus every month, right? So if I'm a creditor and I decide that I'm going to report to the credit bureaus, I have to pay for that service. And therefore, every apartment building, every individual landlord, every cell phone provider, all of those people aren't going to just go out and start doing that, because that would be a large cost to them. But we can build alternative credit that way.
That is good to know. The final question that I have from the ones that were sent in is, I need to improve my credit to buy a house, and I know it, but have no idea where to start. What would you suggest?
Sure. I know that all of us could attest to this. I can't tell you how many times I've picked up the phone and, heard something along the lines of, hey, Carrie, so-and-so gave me your phone number. I've been denied, or I've been told no, or whatever by other people. But they told me that I really needed to give you a call, and they sound hopeless, right? I mean, that's a call that we're all familiar with. And some friend or real estate agent or whoever said, hey, reach out to my person because I know my person will talk to you. And I guess that is what I would not lose hope. I would continue to try and find that. I mean, I know we're those people. We're not credit repair experts. That is not what we do for a living. We're mortgage professionals. However, we, in the process of being mortgage professionals, look at credit every single day. And we have a whole department inside Fairway that is committed to helping people to improve their credit. So if you're in a position where you're really committed to home ownership and improving your credit, we'll help you with a path on how to do that. If you're not in a position where you're looking at buying a house and you just know, hey, I need to work on my credit, then I would say, go to annualcreditreport.com, pull a copy of your credit report, take a look at it, and literally put it in order of lowest balance to highest balance and start knocking them out one at a time. That's what I would do if I weren't in a position where it was time sensitive and I was really focused on a specific goal. I would order them that way and do it. But, nothing more rewarding as far as I'm concerned than helping somebody to create that path, have them follow it, and end up succeeding in the end and becoming a homeowner, because we actually just took the time. Adam, you actually started this whole call out with that and said, I've heard that I need to listen. I have 2 ears and 1 mouth, and part of that's just listening, understanding, and then helping to create a path. And that's part of what we do.
Well, I can attest that helping people who think that they can't buy a house for one reason or another and being able to show them the road to home ownership is one of the best things that I can do. And I think that's one of the things that differentiates CG Home Loan Partners in particular, but Fairway as a whole, that we're here to help. I want to make sure that even if you're not ready now, doesn't mean you won't be ready later. And I want to help you get there. And I'm sure Barb and Chris can say the same thing, that they feel the same way.
Yeah. Well, I know we do, because at the end of the day, we wouldn't all be together if we didn't have the same values associated with that. And so I think that that's shared uniformly. Bottom line, you guys, and I know that there was a whole lot of, well, if this, then that, and if this, then that. And that's just the story. Like I started out with, your fingerprints, they're yours. They're unique to you. My number one piece of advice with regard to credit would be unite with a professional if you're looking at making a large purchase, and make sure that you get a true plan associated with your credit, and that, you know, and it's not too early. I love that question about, well, what if I start the process and then I wait? That's okay. I mean, I can't tell you how many times we pull a credit report, we do a pre-qualification, we say, hey, this is what you'd look at now, but we create a path. And they're like, you know, I think what I need to do is sign a 12-month lease and I'll get back to looking at houses again in 9 months. And they do, and they come back in 9 months and they work the plan, and now they're successful homeowners. I mean, that happens all the time. So we're happy to do those initial consultations, see where you sit, help you create a path to where you want to go. No other questions in the chat or anywhere else here today?
I don't have any in the chat, and those were the last, unless you have any on Facebook that I can't see, but I think
I do not see any others there. Does anybody else have any final parting thoughts before we go tonight? All right, going once, going twice, gone. Have an awesome rest of your Monday night. We will talk to you all soon. Peace.